There is a lot to talk about today. Firstly, I'm going to be talking about Brexit and the developments that have happened in this subject and what this means for UK investors. Then I'm going to talk about two of my stocks that have managed to exceed expectations and continue to dominate in their industries and have pushed up whilst the US market has fallen. And all I ask is that you drop one of these for the YouTube algorithm. So this week, the FTSE 100 has gained 4.21%, the FTSE 250 has gained 1.21%, and my portfolio is up by 5.58%. This doesn't sound too bad, but then it's worth considering that the US market, such as the S&P 500, has dropped by 3.26%, and my biggest position, which takes up 48% of the portfolio, has actually dropped 3.3% this week. And I hope that this expresses the importance of diversification, as simply half of my portfolio didn't perform, but the other stocks I owned did, and they managed to keep it up. But it's important to stay grounded, and that's why I love creating content for this YouTube channel. It's a great way to interact with the community, and it effectively means that I'm hopefully not going to become overconfident in my abilities and blame other things for my mistakes or become hubristic, aka the downfall of Macbeth. Anyway, I'm not going to get excited by these short-term movements. Sure, I've just beaten the S&P 500, the FTSE 100, the FTSE 250 all in a 5-day period, but can I consistently keep doing it over the long term? And that's something only time will tell. Right, so I try my best to keep out of politics on this channel, mainly because I don't have a political agenda towards any party, and politics isn't really where I'm knowledgeable at. This is after all a finance channel. However, Brexit is something I'd like to talk about, as this is something that will impact our investments in the UK and inevitably impact the rest of our lives. And I want to talk about Brexit from a strictly business point of view. I'm not going to say which side is right and what party you should follow, but rather what this means for our investments and the businesses in the UK. With this in mind, there's actually two developments this week. One of them is a very typical political scare, and the other one is actually quite positive news. Firstly, the EU are making threats towards the UK with legal action. And the EU are saying if the UK doesn't change the controversial elements of the internal market bill, then they will threaten them with legal action and burn the bridges between the EU and UK and any hope for a future trade deal. And they've effectively said that they will cut all ties if they make this UK law. Effectively, this bill would keep the integrity of our nations, and especially keeping the divide between Northern Ireland and Ireland at relative peace. So effectively, this would give ministers the power of modifying or removing rules related to trade between the UK and Northern Ireland that the EU doesn't like. I strongly believe that the UK government will not be willing to back down on this one. And I think that the EU is trying to threaten the UK and push less favourable terms so that they can come out the strongest out of the deals. However, from what I'm hearing in the news, and perhaps this is media bias towards our citizens, is that they don't seem to be very successful so far, and if it continues, I imagine the UK are going to keep playing hard. I understand why the EU is trying to threaten the UK, and that's because Ireland is part of the EU, and therefore it is very important that they remain control over Ireland. The idea is that they want, because there is no border between Northern Ireland and Ireland, or no hard border between them, it would be very easy to smuggle goods, merchandises, and therefore get it into the rest of the EU. However, the issue for the UK is that the solution around this that the EU would want is that they build a hard border, which would mean building walls or fences to keep the two nations apart. And that will likely end out in war. I'm not going to go into depth of that, but that really will not keep peace in mind. And therefore, I'm very certain that the UK will go a lot further than the EU will regarding this bill. And I think the EU will have reevaluated this closer to the day and probably back down. On a more positive note on Brexit, the UK has managed to score a £15 million trade boost deal with Japan, which only represents 0.07% of our total GDP, and therefore means that obviously Europe is a big trade partner to us and we still can't really afford to lose it. Regardless, I think this is a step in the right direction, and this is a trade relationship that should improve over time and therefore benefit and stimulate both economies. There's certainly the argument that Japan's economy is trading sideways. They're not really doing anything, and therefore they've also got an aging population. There's no real benefit to us. But I'm sure if travel restrictions were lifted, it would make it very easy for tourism into both countries, and obviously the travelling of goods and merchandises could also spread around, making both countries more cultured, but also increasing the profits. And especially when we talk about the UK here, since we're built on services, hospitality and tourism. So if Japanese citizens come, maybe even live over here, if there's a deal made in that regard, we will likely benefit our GDP a lot more. Overall, I think the whole Brexit situation at the moment will negatively impact investor sentiment, but that doesn't mean that I feel that the stocks will drop. No, but what I do believe is that volatility in the markets will start to steadily increase until Brexit has more certainty behind it. Right now, there's a lot of cards on the table, the EU threatening legal action, the UK having a trade deal with Japan post-Brexit, and I'm sure that the UK could even manage to make more deals beforehand. And I think this presents a huge opportunity for us investors. There could be some excellent buy-in points. More volatility means that stocks could be dropping by a higher amount and therefore allowing you to jump in at an excellent price. In these next few crucial months, I believe that the media will also be very negative. It's going to look better if there's a lot more uncertainty from the media so that the markets will stay down. And I don't know if there is a big conspiracy scheme here, but if these powerful individuals would like to get as much money into the UK markets as possible, it would make sense why they would hold the markets down by delaying the kind of information that we receive as a public relating to the Brexit trade deals. As at the moment, the only information I'm getting is from the BBC and other different news articles. Does this mean I'm going to stop buying UK stocks? Hell no. I'm going to continue buying into the UK regardless of what happens in the short term. Hopefully once Brexit is behind us, I can look to diversifying my assets overseas, but for now I'm purely in UK equities, and 58% of you aren't subscribed. It doesn't cost a penny and it is free, so please consider subscribing. Thank you. A prime example of this is actually consistently averaging money into my position with software or software catalog, as I hope to build this position to over 10% of the portfolio, or more ideally 15% before their results in November. Also, if you look at Softcat's historical price, October 2019, you'll actually see that there was a 20% rally when they entered November. I suspect this is when their results last were, and yes, obviously the past does not reflect what will happen in the future in any way possible. But I imagine results were good back then, and I anticipate results to be very good now. So I wouldn't be surprised if we see that, even if it's a short-term rally that drops later on. And therefore I want to build equity before this pivotal moment, especially because they're going to be announcing their final dividend, potentially a special dividend with surplus income that they've received during this time of uncertainty, and also be paying their interim dividend that they had missed. And I'm actually very grateful that the US market had a miniature sell-off, as this has meant that Softcat had been pushed down from its all-time highs of like £14.40 per share to now sitting around £12.50 per share. I do think there is a long way it can go down, but for now I'm just going to keep averaging into the position regardless if it goes up or down. Softcat fits very well within my investment strategy, which is high profit margins, high growth rates, high dividend growth, and also making sure that they're returning shareholder value. And whilst yes, they could invest that surplus income back into the business, maybe I'm missing out on opportunities where I could gain thousands of % returns, I would prefer that dividend income to be coming towards me so that I can use that money to pick different stocks. This may sound stupid because obviously 78% of people don't outperform the market, but I believe in my own ability, and so far I'm currently outperforming the market. So that money, rather than staying in Softcat, I would prefer comes to me so that I can invest into different stocks. But what I am hoping is that Softcat is a consistent 30% annual average returner, and so far it's well ahead of that. So I've bought 10 more shares this week using my average weekly sum and just developing this position. And I very likely will continue doing this over the next few months until November, until hopefully I've got a big enough position. As I mentioned, this has been a big week for all of my stocks except Softcat and Boohoo. Boohoo takes up 48% of the portfolio and it has managed to drop by 3.3%. And funny enough, there's actually no news on the company whatsoever, and compared to their competitor ASOS, which has rallied around 1.3%, it's certainly underperforming the industry for now. I suspect it's people taking profits and de-risking, as the results are looming. It's about 3 weeks away now, and honestly, time could do with going faster. Hopefully I've had a haircut by then though. I'm not worried in the slightest about the results. I am worried in my own ability. I'm not sure whether I will be selling Boohoo after the results, as it may take up a really high proportion of the portfolio. Say for instance this rallies to £5 per share, that's immediately doubled my cost basis, and that's going to put me at around about 65% exposure in my portfolio, and I may be worth cutting back and reinvesting those profits elsewhere. However, it's sometimes a great idea to let your winners run. So I'm not sure what I will do in regards to this, but I will be holding this stock until that date. Although what is interesting is that my deposits into the portfolio are actually pushing my Boohoo allocation down. You may have noticed at one point it was sitting around 54, 55%, and now it's only at 48%. This could mean that I may not have to cut back this position if I consistently keep building up those other positions around it. Okay, so this week my favourite industrial stock in the UK market, Ashtead Group, has performed better than expectations in the market. They had released their Q1 results, which had actually been negative. Nothing had gone up, yet the stock price had gone up. You may be thinking, why is this the case? Are investors stupid? And in fact, it actually risen by 8.33% in terms of stock price. Their earnings per share were down 35% since 2019 last year. And their profit margins were also down 31% compared to 2019 also. It's important to remember that many of the worldwide economies, such as the UK and the US, were relatively shut down in May and June. Q1 for Ashtead Group takes up May, June and July. Whilst yes, I do believe that they probably were doing better in July than they were the year before, May and June will be dragging the statistic down. But what is impressive is that they've actually only managed to lose 7% of their revenue from the year before. This all sounds bad, but then you realise how well they've managed to increase their free cash flow. And it is currently £447 million from £161 in 2019. And this suggests to me that they'll easily be able to weather any incoming crisis. A second wave of the virus, again, not an issue. Perhaps the worldwide economy goes into a deep recession, I still think they will be fine. Even a US-wide lockdown, which is very unlikely, which would impact up to 80% of their total revenue, I still believe they are a very resilient company and would be fine. And honestly, I think they are probably the most defensive stock I have in the portfolio, but with also high growth potential. Once more, I have no concerns with this company, and I do believe, as long as there's not another lockdown, that Q2 results will be above expectations. I'm currently up 10.16% on my investment and will continue to add on any weakness, but now it is above my target allocation of 10%. I will likely top it up if the share price drops below 2,600 pence per share. The biggest surprise to me this week was actually the trading update from Games Workshop. This wasn't even on my radar. I wasn't ready for any trading update, and to be honest, I didn't even realise that their AGM is in less than a week away. Regardless, what they had said in this trading update is that the results had actually exceeded the board's expectations, but also that they exercise caution and that it is only the very start of the financial year and things are subject to change. And this trading update, which goes up to August 30th, in 2019, they had a total amount of sales equivalent to £78 million. However, in 2020, they've now gotten 90 million sales in the same period. And they've had a fantastic increase in their operating profit from 28 million in 2019 to 45 million in 2020. It's no surprise that this stock has rallied to over £100 per share, and it's going to keep going up. Games Workshop remains to be my favourite stock in the whole of the UK market. And honestly, whilst yes, in hindsight, I am regretting putting more money in it, I do believe that this should be my biggest position in the whole portfolio. And so in future, I'm either going to deposit more to push this up and have a 30% allocation, which is up from my 20% target allocation, and probably move Boohoo down to around 25%. This would mean, yes, that the top two companies in my portfolio would take up 55%, but I'm only holding 6 companies anyway, so it does make sense to me. And I'm still extremely impressed with the growth of GAW, considering they always give away surplus cash to their investors, and distributing that to shareholders is one of the best things a company can do when I'm looking for a stock. In fact, they had also increased their dividend for November. This is a quarterly payer, which would have been 35p, but they increased it to 50 pence per share. This is an increase of 42%. That's incredible dividend growth. Currently, I have an allocation of 24.3% to Games Workshop. I'm definitely going to ramp this up because they're a company I understand probably the best out of all of my holdings in the portfolio. I'm likely their target consumer, and whilst yes, I do not buy the collectible figurines, but rather I am part of the way they earn income through royalties. It's also worth mentioning that Games Workshop are a company that is relatively immune to the impacts or after effects of Brexit. They're well diversified between nations, and therefore pound strengthening or weakening does not impact the stock as much as other companies. But also because they're able to set up retail stores across the world, this means that they're able to expand their range at which they can ship or develop their products. They also have the ability to market their products worldwide using the internet. And this is actually what has led to them growing so much. Their retail stores are still struggling due to the pandemic, but their online sales growth is incredible. They could very easily transition to an e-commerce stock, which would likely put them in a much better position and furthermore increasing their profit margins even further. However, it does seem that investors price down this stock due to it being mainly retail, or that's what they think. But in reality, I think in the future this is going to transition more away from just these stores, but these stores are still very profitable, but to a much more online-based retailing. Pricing it at 40 to 45 on earnings, of a price to earnings ratio, just simply doesn't fit this company. I think they're a high growth company, and honestly, I would probably willingly pay 60 price to earnings. It's also at that point where once you hit a certain threshold in price to earnings, people kind of lose connection, and that's no longer a metric that people look for when investing in a company. Look at Tesla, for example, maybe Amazon, or even ASOS. Games Workshop has rallied 18.16% this week, or up to £101.50 per share. My position in total is now up 23.4% or £579. You may be thinking, if I'm only invested in UK equities, how am I protected from Brexit? And a lot of people have said, well, you need to invest in US stocks, otherwise you're at risk of the UK market underperforming as usual. Well, I actually diversify my UK equities across the markets. The FTSE 100 is a well diversified in terms of income streams between many different currencies across the world. The FTSE 250 has some of this, but is also very domestically exposed to the UK economy, and the AIM market even more exposed to the UK economy. This means I've tried to go for target allocations. There's always a plan for how much stocks I own. I've tried to aim for 30% of my portfolio to be in the FTSE 100. This gives me a relative hedge. If Brexit goes poorly, doesn't go well, that 30% in FTSE 100 stocks such as Halma, Ashtead Group and London Stock Exchange will likely hold their value and perform well, or just hedge the portfolio. Whereas the other 70%, which currently I believe is 76.4%, is invested in mid-cap companies. Companies such as Games Workshop, Boohoo, Softcat. All of these companies are there, but I think they will benefit the most if Brexit goes well for us. And I'm very bullish on the outcome of Brexit. Yeah, they're giving the tough talks now and they're saying doom and gloom, but I think this is to keep markets down. I don't think they would be silly enough to completely destroy trade links. And even then, I think the EU has a bigger issue with the UK leaving than the UK has an issue with leaving the EU. And even if we are in a potential recession, I think these stocks will benefit the most. The example of one of my hedges is Halma. I spoke about this in the last episode of the portfolio updates, and if you are interested in that, I'm going to put the card at the top right of the video. But this is a company that typically generates shareholder returns by doing mergers and acquisitions, meaning they're going to be looking for these smaller companies and buying them up. And so these companies may be struggling due to Brexit or the largest potential recession of our lifetimes, and they're going to come in and acquire them, potentially at cheaper prices, and therefore benefit like that. This means that they're also well diversified, not as impacted by Brexit, since they are still quite domestically in the UK, and it puts them as one of the defensive positions. Another example of this would be London Stock Exchange Group. Although in hindsight, I do think this is probably my riskiest holding in the whole thing, simply due to the acquisition or the potential acquisition, which has caused speculation, and therefore the share price being a lot higher than it could be due to the acquisition of Refinitiv. And this could go poorly, or the EU could even potentially leverage this in the Brexit negotiations. They could say, no, we're not going to let London Stock Exchange acquire Refinitiv unless you give us access to Northern Ireland, in which case the UK will probably say no. and then that's London Stock Exchange's share price crashing. Although they may be interested in the Italian investment arm, so perhaps there are some things to go here. I hope that London Stock Exchange isn't impacted by Brexit in that way, but therefore I'm not going to be increasing my exposure to this company. It takes up around 10.8%. I'm not going to be adding to this position until I can have more certainty, which would mean that investors will become more confident themselves, and therefore the share price will likely rally, but I'm going to wait that one out. London Stock Exchange should benefit from a fall in the pound, as that means UK equities increase in value. It also means that interest rates are very likely to stay low for the next 5 to 10 years. When interest rates are low, people don't want to put their money in a bank account gaining 0.25% interest rate, but rather they'd invest it in stocks. There's a lot more reward to be gained from that. And so what will likely happen is London Stock Exchange will gain from the increased amount of investors, more people using their media services, and also the benefits from each individual trade. For Halma, I'm currently up 2.61%, or around £17. Only takes up around 5%, 5.5% of the portfolio. And I'm also going to build this up as well as Softcat and switch between them in the next few months. If you're interested in my National Express stock analysis, then click the card at the top right of the video. This is the Ozbourne Foreman Show. Thank you for watching. Stay safe.